please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, nothing much to incrementally talk about for the markets except for stocks such as HDFC Standard Life, which are seeing some amount of traction on the upside. So that stock is up 5.5%. We have a couple of these pharmaceutical stocks which are gaining today as well. So Suven Life Sciences up 4%, Wockhardt, which is up around 3% and Aurobindo, which is up around 4% at this point in time as well. So that interest within the pharmaceutical space and maybe even hospitals and healthcare at this point continues. But the big stock in focus will have to be Yes Bank. The hunt for a new CEO will be the top focus at Yes Bank's board meet today. Ritu Singh is here with all of the details on what is likely on the agenda and who are the possible candidates and what will Rana Kapoor's role be post the 31st of January. Ritu.
Two key items will be on top of the agenda of the board members of Yes Bank as they are set to meet to decide the future course of action. One is the appointment of a new MD and CEO as Rana Kapoor steps down by the end of January next year. Here we understand that a search committee will be appointed and they will look at both internal and external candidates. Rajat Mongawa and Pralay Mondal are among the strongest contenders internally. Externally, of course, also the search committee could look for more candidates to bring in more credibility to the bank. But that aside, the final stamp of approval lies with the Reserve Bank of India when it comes to the selection of the CEO. The bank can merely make recommendations. The second and the more complicated matter is that of Rana Kapoor's future role in the bank. Currently, by virtue of being the MD and CEO of the company, he is also a whole-time director. But the legal opinion is that by giving up that position, he also gives up his position on the board of the bank. But do remember, the articles of association of Yes Bank do say that Rana Kapoor, by virtue of being an Indian partner, is not liable to retire by rotation. But there is a conflicting view in the Banking Regulation Act which says, if a whole-time member relinquishes his position, he is also not liable to be a director on the board of the bank. So, which way, the board opinion swings or what Rana Kapoor is likely to do, as further recourse to this, it remains to be seen. But it is, widely expected that this could end up in the courtroom.
Ritu, thank you very much for that. Let's also listen into what Ajay Srivastava had to say about the leadership issues at Yes Bank.
I will be a buyer today. As I said, RBI has not come back and told us that something drastically wrong with the bank. And my call may be wrong. My worry, RBI is not saying anything about it, that anything serious is there. Yeah, divergence, yes, we understand that. But beyond that, RBI has not said anything.
Okay, so that's the opinion coming in on Yes Bank. We now have Ashwini Gujral joining in to talk about the technicals of the market. Ashwini, over to you then. What are you recommending for what is turning out to be a choppy session? Because now the mid-cap index has given up all of its gains that it had earlier.
Well, the pullback rally seems to have ended. There's a good time to get short on Nifty, Bank Nifty. We've hit zones which are key resistances and the market is clearly failing there. I don't think there is much of an improvement in either crude or rupee, etc. So this kind of a rally with the intraday high, which we just made about a few minutes back, should be used to sell into the market. I think the bears are way too strong to let this sort of a rally go. I wouldn't be surprised if we, hit the morning lows because the market is in a fairly strong downside momentum. And with this sort of bounce, I think fresh shorts are easily can be taken more easily than at lower levels. Having said that, Wockhardt is a buy with a stop of 560, target of 585. Coal India is a sell with a stop of 282, target of 268. And Reliance Infra is a sell with a stop of 325, target of 310.
Okay, Ashwini, morning. Financials, again, the weakest pocket, according to you?
See, obviously, given the macros, there's no reason at all to buy into financials. And given these 2%, 1.5% style rallies, these should be used to easily sell into financials. Financials are getting derated. So whether they go up or they go down, money keeps coming out. And my sense is that people should have sold as we made those highs. because now it's only a matter of time before rupee weakens further. So that way, there's no reason to have fresh money go in there. We were very, very oversold, and I think this 500-point rally from the lows on Bank Nifty, and maybe I think about couple of 100 points on Nifty really takes care of that oversold position.
Okay. That's on the financials, but what about the stocks which are directly linked to crude? BPCL, HPCL, Jet, Interglobe. What kind of strategy would you recommend on them?
This market is in a strong downtrend. So other than say an IT pharma, basically everything you can go short on. I think all of these HP, BPs are in a clear bear market. Now the bigger issue is what happens to stocks where people are making money. So I would be very skeptical of what happens even to IT and pharma now, because how long can they keep standing against a market which is moving lower?
But Ashwini, just to counter that, Sun, for example, has gone up only 12% on a year-to-date basis. I mean, do you think that despite the overall trend in the market, you individually or, that counter technically on its own would have more to go, and hence there could be incremental interest?
Sun Pharma goes up 2%. Bajaj Finance falls 8%. DHFL falls 18%. So where is your bang for the buck? I mean, sure, something will go up in the market, but you can't say that they are in any sort of great bull markets. Yes, they tend to go up a little bit, but the big trade is on the downside. That is where the overvaluation and over ownership is getting corrected. So that's where you need to be looking at.
Okay, let's just put up the Piramal Enterprises chart. That is, 2490. What a reversal! I mean, I think it was down 10 yesterday, sold off pretty sharply. It was up about 1.5, and it's now down 1.5 with the market losing steam. Look at Bajaj Finance. I mean, I think on the futures it had gone up to about 23.20 or so, at about 22.80. Look at Yes Bank, was about 235, 236, at about 231 now. And Indiabulls, housing and DHFL, of course, have been problem spots for a while. Chola Finance was at about 1205, 1206, and under 1200 now. The one name which continues to surge and surge is M&M Finance. It's up 6.5%. You heard from the management earlier in the day. M&M Finance, I think for the last at least 2.5, 3 years hasn't really done very much. I mean, it's basically been in a range. So that is surging as we speak. Okay, 5 points now, almost down in the negative. What moves? I mean, we were up 75 on the Nifty at about 11.05, 11.10, and we are almost in the red now, 10,972 on the index. I think we've got some questions from viewers for Ashwini. So this is a Twitter user who's writing in. He's got 500 shares of IDBI Bank. His price is 60 rupees a share. Wants to know long-term view on IDBI Bank. Ashwini?
Right now, what you can do, you have a lower quality stock, maybe increase the quality, but adding on, etc., I don't think is going to work here. Maybe take the strongest bank and get there, something like, Axis Bank, etc. But overall, financials are looking weak. So maybe, get into an Infosys, at least it'll keep you safe if nothing else. But, banking, financials, you have to get out. There is no other option.
Okay. All right, Ashwini, going to leave it on that note. Thanks very much for joining in, taking us through those technicals. Need to take a break now. But up next, Edelweiss has come out with a report on the economic recovery seen in the recent months and whether that holds any legs or not. 12
points now, so threatening to break down into the red anytime. 10,982 is where we are at this point in time. All this tumultuous kind of activity in financial markets is also going to lead to questions about growth itself, underlying growth. Is it really for real, or is it a mirage, etc., etc.? Edelweiss has put out a report essentially asking that very question. Is the growth that we are seeing, is that real or is it rudimentary? I mean, Aditya Narayan is head of research at Edelweiss. Kapil Gupta is research analyst with Edelweiss. Both of them are with us here in the studios. Gentlemen, thanks very much, both of you, for being here. So, Kapil, you're the author of this report. Why don't you tell us what is the sort of basis for exploring this question?
So, there are two parts to the report. In the first part, we essentially try to get to the underlying trend in the economy, because in last 2 years, there's a lot of disruptions in the base, and year-on-year numbers are, in our view, not telling the true picture. So we have tried to use 2-year trend in several indicators, about 30 plus indicators across consumption, investments, external trade, and try to pinpoint what is the underlying growth rate in the economy, and more importantly, whether that underlying growth rate, how does it compare with the business cycle over time, starting 2003 onwards. If you take the business cycle, what is the best we have achieved and what is the weak phase we have seen, and placing those underlying growth rate in that context, so that we get a sense as to how, today's numbers, are they strong, bad, good, below average, and that kind of a thing. And we have also tried to make sense of what's happening on the global economy and balance of payment front, and how it will shape the economic outlook.
So where exactly are we based right now, Kapil? What are the indicators that you looked at? What's looking strong and what's not looking strong?
So across indicators, we've looked at outside GDP growth rate numbers. We've looked at credit, money supply, corporate sales across sectors. And we have divided them into consumption indicators and investment indicators. And our key point is that barring couple of pockets like autos, certainly is a very strong pocket. There is another government spending which has been very strong, held by crude oil prices earlier, which in the last 2 years have been a big support to the capex cycle. But outside of that, we are about at pre-demon trend, which I would characterize as about average. So it's an economy which is still firing on pockets, but is yet to turn into a full-fledged that circular flow of production, demand, and income.
Pre-demon, we were at a stage where it was believed that we're just about to take off, right? And then demon happened.
Yes.
So we're again at the stage where we're about to take off. Is it what you're saying?
So obviously there is an outlook part to it in some sense, but in terms of the level of activity, I think we are at the pre-demon by and large, barring few pockets, as I said. The outlook is obviously another thing, which is, things are moving very fast on the global front and on currency and liquidity, which we also try to cover in this report, where we are saying that, emerging market outlook has significantly deteriorated for a number of reasons. So
and we'll come to that in just a bit. Aditya, how would you tie those macro conclusions to markets and for investors?
No, actually it ties in very, in a very straightforward manner. We are neutralish on the market. Our sense is that the market range over the next 6 to 9 months is going to be a 10,500 to 11,500 kind of range, which is where we are bang in the middle. And that ties in with the fact that as far as the economic recovery is concerned, I think the headline numbers that we've been getting are, being interpreted in an exaggerated manner, right? And the fact that there are headwinds in terms of looking beyond would suggest that you can't make the call that the economic recovery is upon you, and so you can start valuing the market up or expecting substantial growth from here.
Sure.
So there are headwinds in terms of the economy to where you've come, and the same is translating into the market. Obviously, with the market, there are other factors in terms of how you're relatively valued, some of the ups and downs you've had in the fixed income market at this point in time. But otherwise, it ties in reasonably well with the fact that you have made strides on the economic front, but it's not a given, and you don't have enough data support to suggest that it's very broad-based.
Aditya, the point that Kapil made that, autos are looking good and consumption, yes, is not as robust as autos. But do you expect that to sustain in the next couple of months? Because we're dealing with the fact that we could be staring at higher inflation, higher cost of funds, with the RBI possibly hiking rates soon enough. So what's your sense in terms of where we're going next couple of months in terms of demand?
Yeah, so I think the way we would look at it is that there's not enough that's happened to derail what is happening. But clearly it's something that you shouldn't be extrapolating more growth, and it's something that you need to actually watch fairly closely. And I think some of the market reactions that you've seen as far as these stock prices are concerned is reflective of the same, that this is not necessarily a 4-5 year cycle, in part because the externalities around interest rates and liquidity and stuff like that have kind of weakened, or at least have had a bit of a jolt.
Ajay, how would you interpret what's happening in the market right now? I mean, because it kind of is going to throw up those questions. I mean, I prefaced my my comments before we began the interview with that, right?
No, I think in many senses, I think this is what Kapil had written about, that one, there is a domestic element to it. The other is there actually a much larger global element to it, because US rates have been rising. In the US, bonds need to be bought back. Where will that money come through from? So I think to some extent, this is largely in line with what Kapil has been saying. In terms of the impact on the market per se, I think to some extent there was a certain amount of risk tending to build up. I think what has happened is really an event risk with a backdrop of high valuations and some
to take
build-up.
Kapil's conclusions, I mean, if you take those, the point is, the one thing which people push back with is that growth, this is an economy which is recovering.
Right.
When I saw a report this morning, I think Morgan or someone saying that, well, this is not 2013, everything else is very different, etc., etc. Because the economy is recovering, corporate profit growth is recovering, etc. So there's no reason for a big event in that sense. This is an issue which will pass over.
See, I think nobody is debating the fact that growth is not recovering, right? What one is debating is the pace of it and the extrapolation of how rapidly that will actually bounce back. And when you look at markets that are well priced, then a change in pace, or when there are disruptive elements like you've seen in the more recent past, or there's a greater appreciation of risks that were not looked at earlier, then you can have a delta impact as far as markets are concerned, as far as businesses are concerned, and at some level as far as confidence is concerned. And I think you're seeing some of that play through. It's obviously in the backdrop of high valuations in absolute terms and higher valuations at the market level in relative terms.
Okay. Kapil, no, we're just running short of time. So I had a quick question with regards to exports, because we're now almost touching 73 for the rupee, but we're not seeing exports pick up to say $30 billion, on a monthly run rate. We're still within a range in the past couple of months. What is your sense in terms of where we could go?
I think two points need to be considered regarding exports. One is how much INR has weakened on a broad-based basis, which is across emerging markets spectrum, and second is what is global trade doing. So on the latter, there's a very tight correlation between dollar strength and global trade. Typically, we have seen over the last 30-40 years, periods of dollar strength do not augur well for the global trade activity. So one risk is that the global trade itself could moderate. The second one is that the INR has weakened. It's about average in emerging markets. Of late, it has fallen more than others for sure. But it is not a situation where in 2013, INR saw the biggest fall, and therefore there were huge gains on competitiveness. So there were average gains on competitiveness, and global trade is moderating. So to that extent, the expectation that export will see a big bounce need to be moderated, according to me.
Okay.
I think that's also an area of structural weakness for the economy in the last 1 or 2 years, where employment-generating sectors have actually tended to be very weak. So I think fundamentally one of the challenges that the economy you've got to look at is that the competitiveness vis-a-vis the rest of the world has not moved. If anything, at some level, we missed the early move as far as emerging market exports was concerned a couple of years back.
Are you expecting maybe credit to become a little constrained because of what's happening with the NBFCs?
Clearly, I think it's going to be a little bit of a challenge, because what you do have is the banks are constrained from a pure risk appetite perspective. They're lending a little bit more now, but I'd be surprised if they go out whole hog. In terms of the NBFCs, I think what will happen is both between providers of finance, which is the liquidity providers to NBFCs, and the NBFCs themselves, I think there will just be a little bit of stepping back that will effectively happen. So it's not necessarily a constraint that's external, but it's a combination of internal and external caution that could slow things down a little bit. So that's been a good valve in terms of the leverage that you've needed for the economy. And that's going to face a little bit more scrutiny. Obviously, we're in the midst of it, so we worry a lot about it. It's not going to be as dramatic as what you've seen over the last couple of days. But at the margin, I think it starts making a difference.
Housing finance company, right? 20-year loans, small NPAs, average repayment gets done in 7-8 years. What could potentially go wrong? You could also sometimes wonder.
Effectively, I don't think it's a credit call. I think it is a call on two things. One, the providers of this liquidity, they're just going to be a little bit more watchful, and it's a function of the development of the market. And I think from a lender perspective, I think people are just going to be a little bit more watchful.
But as we speak, do you think this indiscriminate sell-off is maybe behind us, or you think?
I think that event is over. The event risk is, I think, has played out over the last couple of days. Right now, it's a question of when you think of the event risk, when you factor in the event risk, when you've run a wholesale lending business without looking back for the last 4 or 5 years, then there's just going to be that self-imposed caution that could pull back growth a certain amount.
The RBI has announced bond buyback through open market operations worth 10,000 crores. DBS has written a note on how this is going to impact the money markets as well as their overall perspective on what could happen once the second half borrowing calendar would be announced by the RBI as well. Radhika Rao, economist at DBS Bank, joins in now to discuss this. Radhika, hi. Thanks very much for taking the time out. So what's your sense first in terms of how crucial the second half borrowing number could be for the bond markets?
Hi, so in the first half of the year, when the borrowing schedule was announced, there was a relief rally, mainly because the government had actually borrowed less in the first half, pushing back. So there was some sense of backloading in the borrowing schedule. So now we have seen a first half where about 2.6 trillion roughly about 40-45% of the full year borrowings have already gone through. Now we go into the second half, and there have been indications that they could spring up a positive surprise to mean that the second half borrowings might not be as big as earlier feared. So that is in itself, it's a positive, but I think that will require for them to reduce from the 3 trillion plus it is required would mean they will have to have a bigger cash drawdown, or they'll have a smaller buyback component that can bring the size down. But it's also about how the markets perceive it. So I think if you see what's happening in the credit market in the past couple of days, the sovereign bond yields have actually not really reacted much to it. They have largely moved in about a 10 basis point kind of range. That's primarily because these OMOs were largely expected. And because it's coming to pass now, I think it's a good sign. But it's what the markets on a whole confident. How confident are they on the ability of the government to retain that smaller borrowing schedule for second half of the year?
Radhika, do you think there will be a specific liquidity line for mutual funds, or that will be needed at some point? I mean, what's your sense?
Given the weekend's supportive comments from the authorities, followed up by the Finance Ministry on Monday, we would have assumed that a liquidity line, probably along with the OMOs or separately, would have been announced by now, because the markets are fairly choppy, leaving aside the small pockets of calm. So we have seen that back in 2013. I think, if I recall correctly, it was about July when the government when the central bank had announced a 3-day repo facility for mutual funds to tap on. In most cases, what happens is, the mutual funds might not even tap on to the window. It's just a sense of relief, a sense of liquidity option that's available to these parties. So I would have thought that it would have been announced by now. But one can also look forward to next week's RBI policy meeting, where along with the policy decision, we might see some of non-policy rate decisions taken as well in terms of liquidity relief. That's something that we're looking forward to. But I would think for them a trigger, given the state the markets were in, this would have been a trigger enough for at least a temporary window to be established.
Radhika, in terms of all of the probabilities that you're working with right now, what would your estimate be on the yield? Where do you expect it to probably harden to, and the range?
So we are largely working, 8.23, 8.25% for the 10-year would be a very strong resistance for the time being. So like I said, despite the negativity in the credit markets, the sovereign bond yields have really not moved much. So if the OMOs, the bond buybacks, are made more regular, in 2 weeks' time, we've already seen 2 tranches after a lull since July. So if the OMOs are regular, it's able to take up that liquidity fear from the markets, then I think we can see yields settle around the 8% mark. But if the credit fear remains coupled with rupee under pressure, Now, the rupee angle is the one that I think is equally important for the bond markets, not only from the FPI perspective, but also from liquidity perspective, given that the central bank does intervene at crucial levels. So if rupee does not, it comes under renewed pressure, it's already almost went about 73 today. If the rupee remains under pressure, OMOs is not regular, then I think we can expect a breach of about 8.23 to 5%. But if it maintains where it is and OMOs become more regular, I think we should see it settle at about 8%. So plus minus, I would think an 8.05 or 8.25 would be a range that we'll be playing with for the 10-year.
Okay.
And this is on the long end of the curve, and the short end, of course, are mainly it's mainly reflecting the rate tightening expectation.